Yes Bank loan growth has picked up in the past few quarters and suggesting banks increasing willingness to lend vis-a-vis investing into credit substitutes. We see this trend continuing in the ensuing quarters as the credit cycle stabilizes and as interest rates decline. So overall, we're expecting a robust loan growth of about 29% over the next couple of years. On the deposit side, the bank has been adding granularity. The CASA ratio has been improving fast, driven by robust branch addition as well as improving maturity of the branches. We see this continuing, and the CASA ratio is estimated to improve by an equal extent in FY14 as well as in FY15. So the share of overall retail franchise, which is a savings account plus the retail term deposits, has now increased to 26%. So moving in line with the overall bank strategy of adding granularity. On the NIM side, the near term as well as the longer term outlook is pretty positive for the bank, whereas CASA improvement and also the improvement in the asset mix will act as structural levers. We think that the benign wholesale rates as well as the impending capital infusion of up to $500 million will be near-term catalysts as far as NIMs are concerned. So we see a very strong case of NIMs improving by 15 to 20 bips through FY14 and by 10 to 15 bips through FY15. So overall, we are estimating an NII growth of about 32% on a balance sheet growth of 24% over the next couple of years. I think even the bank has been managing the operational metric pretty well, and if you look at supported by the strong fee income growth as well as the strong margins, the bank has been easily able to absorb the higher investments made in expanding the branch network. So we think this trend should continue as we see the trend in the fee income being robust as well as a strong margin expansion is underway. So we think that the cost income ratio would be reined in within 40% over the next couple of years. As far as asset quality is concerned, delinquencies have been marginal as reflected in the negligible gross NPL ratios. We think given the fact that the bank has got a more short-term, granular as well as a diversified exposure on the commercial and the corporate banking side, the asset quality should hold up well. For the first time, the bank has given a guidance of 50-60 bips for the current year, and that really alleviates our fear with respect to any negative shocks in the asset quality in the current year. So despite factoring in a slightly higher credit cost in FY14 as well as in FY15, we don't think there would be any dilution in the ROA delivery as well as in the earnings growth. The stock is corrected by 15-20% in the past 1 month or so, and we think that one should buy into the correction and should be looking at a 10-15% near-term upside.